The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. He's seen so many profit reports this week, he's changing his name to Underlying EBITDA. It's Anthony McDonald. How are you, Anthony?
Good, James. I love your use of the word underlying. It hides so many sins, doesn't it?
Absolutely. Well, this week we extract 5 rolled gold nuggets from earnings season. We preview the $20 billion mega deal that everyone's going to be talking about. And we take a question on where inflation goes next. But first, Anthony, let's start with Friday's breaking news. And the banking regulator has gone after ANZ, questioning its non-financial risk management practices and whether it's really serious about fixing the behaviour in its markets business. Now, APRA has said that it has long-standing concerns about ANZ. It's yet to observe significant improvements in its risk management processes, and it slapped them with an extra $250 million in capital that they've got to hold. Anthony, this sounds serious. What's it all about?
Yeah, this is not good, James. Those issues in its markets business, I mean, they're real, right? The poor behaviour that's had some traders sacked already and is likely to cost executives their bonuses. It's now a regulatory issue as well. And APRA said it's been concerned about ANZ for a while. It imposed this $500 million capital charge on ANZ. Now, a capital charge is sort of like a requirement to hold an extra $500 million of capital. It's a bit like a suspended sentence or a fine that you never pay, right? So it slapped that charge on them 5 years ago while the bank cleaned up its markets business. But APRA said on Friday that it hasn't observed significant improvements in that remediation that was supposed to be going on. And it sounds serious, James. This all comes back to some stunning reporting about our colleagues Jonathan Shapiro and Aaron Patrick, which we've spoken about before on the podcast. They revealed that ASIC, the other regulator, was investigating a bond deal that ANZ did and some of the trading of ANZ's around that bond deal. And then they also blew the story open with some really salacious details about some of the cultural problems in that markets team. Now, ANZ, it said last month, it's looking into all this. It's confirmed the ASIC investigation. It's said that it's got rid of some of these traders and was addressing it. But APRA's entry into the story and the additional capital charge, James, I think this elevates it. This really raises the potential that there might be long-term consequences out of this, both for ANZ, for its investors. I mean, this, we could get to the stage where ANZ has to enter an enforceable undertaking or something like that, James, which we've seen in the past with banks. We saw it a few years ago at Westpac. And as soon as you're doing that, you almost got to take your eye off the ball, right? Your primary focus becomes very much on remediation rather than necessarily serving customers, making money for investors, and you can pretty quickly find yourself sort of stuck in a regulatory quagmire. So in terms of the extra $250 million of capital, James, ANZ can afford it. They're the highest capitalised bank in the world, according to CBA's presentation last week.
Yeah.
But I think this is bad news, James. I mean, what do you think it means for ANZ's board and CEO who have been trying to weather this storm in the past couple of months?
Oh, this is, forget the money. The money doesn't matter. $250 million is the equivalent of money down the back of the couch in banking circles. This is entirely designed, I reckon, or it appears entirely designed to embarrass the chief executive, Shane Elliott, and the chairman, Paul O'Sullivan.
Yeah.
This is, now, the historical context that you went through, some of it is really important. Back in 2019, when APRA first hit ANZ with a capital charge of $500 million for these risk issues, it actually hit all the banks with a similar amount. This was in the wake of the Banking Royal Commission. It was a, hey guys, clean up your act type thing. Now, every other bank has either had that capital charge removed or reduced, but not ANZ. So basically, ANZ might have convinced itself that it's fixed up its risk governance processes. It hasn't convinced APRA. And now it's sort of sleepwalked into this latest scandal. And the pressure goes straight to Elliott and it goes straight to O'Sullivan because Elliott's been there since 2016. O'Sullivan's been on the board since 2019, chairman since 2020. Now, in the wake of the Royal Commission, everybody was, on edge, right? You would have thought that fixing this stuff would have been priorities number 1, 2, and 3 back then.
Mm-hmm.
But ANZ still hasn't got its head around it. That's what APRA is telling us, that the problems here are persistent and ANZ just hasn't come to grips with them. And now it's got this fresh scandal. So this is bad. This is a bad look anyway. But the pressure is building on Elliott and O'Sullivan, and the ANZ board has lost control of the narrative here. They put something out a few weeks ago sort of saying we give ourselves a clean bill of health. The regulators have looked at that and said, don't care what you say. We don't give you a clean bill of health. And that just means the pressure just keeps building. Anthony, so often we see it gets to the point where the board needs a circuit breaker, and that's often, what was a senior person leaving. I don't know if we're there yet, but we're getting close. When you lose control of these narratives, it gets really uncomfortable, and I think we'll have to see where this goes.
Yeah, tough Friday for ANZ. Okay, James, one of the big profit results of the week was from a property company called Dexus, which is Australia's biggest office property landlords. Now, the news wasn't great. Office property valuations are down 25% from their peak. But James, Dexus reckons the bottom is in sight. Do we believe them? What do you think's happening in the office market?
Oh, well, I think the bottom might be in sight for Dexus, but I don't think the bottom is in sight for all office property. And the reason I say that, the biggest word in the property sector for the last few years is bifurcation. So the gap between the really good office buildings, the 6-star, in the middle, in the right places in the CBD, fancy as, and then you've got all this other stuff, that the B grade and C grade stuff there. That's the 30, 40, 50-year-old office buildings, bit tired, bit run down, no fancy bike car area in the basement, no great showers, end of trip facilities, all that sort of stuff. So, yes, Dexus can make the argument that those good buildings, those really premium buildings that it is mainly in, are close to the bottom after falling 25% in value. But this other stuff, the B and C grade stuff, no one wants that stuff. No one wants it. No tenants want to be in there. No banks want to fund it. No landlords want to own it. So I think there's still a lot of downside there. What's really interesting, you're in Sydney, Anthony, I'm in Melbourne, but Dexus had this great slide in their presentation, a map of the Sydney CBD, and you sort of hear Sydney CBD, all one office building, what's the difference? But there's a huge difference. There's this area called the CBD core, which goes from Martin Place back to Circular Quay. That's where everyone wants to be. Occupancy in that zone, high 90s. And then there's this area in the CBD, the western flank, sort of around Darling Harbour type area. Occupancy down there is in the 70s, 70%. So, there's what, I don't know, 900 metres difference between those two areas.
Yeah.
Not that big a gap. And yet the occupancy levels are huge. So these gaps in the market are ginormous, and they're not going to close anytime soon, I don't think.
Yeah, it's kind of Dex's way that telling us the rich are getting richer and the poor are getting poorer. In a way, if you've got these big flashy buildings, the ones that Goldman Sachs are in and Morgan Stanley and UBS and, in that financial district, you're sweet. People want to go to work in those.
Yep.
But if you're a little bit outside that zone, it's tough times.
Yeah, the interesting thing too is that the work from home story hasn't played out completely. I expected them to say, we're sort of getting back into some normal patterns of work, and I think that's true. But then you get this thing like the New South Wales Premier a couple of weeks ago effectively trying to order the public service back into the office, and so everything might shift again. Maybe not completely, maybe just subtly, but we still haven't seen where that work from home story is going to settle. So that's really interesting too. Well, Anthony, let's move to our first big topic of the week. And one of the things we really love about profit reporting season is that it gives you this incredible sweep of the economy. We get to have a look inside nearly every sector and pick up on some important trends and the occasional crazy factoid. So what we're going to do today is extract 5 nuggets that we've picked up that we hope might tell us something about where things are tracking. Now, I'm going to start, Anthony. I had a look at the results of a company called Breville, which makes appliances that can be found in most kitchens and homes right around Australia. Also in the US and in Europe. I've been looking hard for signs that the economy's sort of rolling over, that consumers are under pressure. But in the 6 months to the end of June, Breville's sales of coffee machines, now it makes some coffee machines that go up to $3,600.
Oh.
They were up double digits. So that's an incredible boost in sales. And Anthony, I've been thinking all about this all week. Is this a sign that the consumer's doing well because they can afford a coffee machine that does everything for them? Or is it a sign that households are under pressure because they're trying to save money by not going down to the local cafe?
Good question, James. I reckon if you can afford the $3,600 coffee machine, you could probably afford the $4 takeaway coffee. But, I mean, what does the $3,600 coffee machine do for you, James? Does it cook you a little biscotti, or does it wash your coffee cup for you? Does it grow the beans? Far out. Must be good.
I learnt far too much about how the coffee machine purchasing process works, but apparently you start with a manual coffee process. I guess maybe just a couple of spoonfuls of Nescafe in the kettle, and then as you grow to love coffee, you might move up to an espresso machine, and then you go up to something a bit more fancy, and then finally you find yourself shelling out down at JB Hi-Fi or Harvey Norman, handing over $4,000 for a new coffee machine. So I'm not a coffee drinker, Anthony, one of my many faults, but it's a wild world out there for the coffee drinkers.
Absolutely. That's a nice one, James. I love the industrial companies' results. You know, the things you can picture, the simple things, the things that we have in our homes, the things you can see around town. Now, I looked at Cleanaway Waste Management, which is one of Australia's biggest garbage collectors. It collects for more than 100 council businesses, a little bit of industrial waste. Big player, big blue trucks. People would have seen them on the streets. Now, anyway, its earnings margins increased 100 basis points this year. Now, what that means is, so for every $100 revenue, it made an extra $1 in earnings, basically,
Nice.
which doesn't sound like much, but it all adds up. Now, why? The Cleanaway boss, Mark Schubert, who's a listener of this podcast, he said one of the reasons was the labour costs. Now, back when the jobs market was red hot, remember when unemployment was 3.5%, the immigration influx hadn't really properly started yet. Cleanaway couldn't hire for love nor money. It had more than 1,000 jobs vacancies. It was trying to pinch hairdressers and childcare workers and turn them into garbos, and it was really dire for them. So the company still had to pick up all the rubbish. So it's had to make its existing workers all work more. Now, the garbos who earn about $30 an hour, I mean, they would work their normal 7.5-hour shift, and then they'd have to do overtime, right? And then now overtime, they get paid time and a half for the first 2.5 hours, and then after that, it's double time.
Right.
And Cleanaway, the boss, they have to pay it because you know they've got to fulfil the contracts, and the councils who pay them have to pay it as well. So basically, it just meant they were paying a lot of overtime. Their staff costs were more expensive. So they've had to cut back on that overtime, and particularly that double time part. So they still roster staff on for longer shifts, let them earn some overtime. They're now putting them on for like sort of 9.5-hour shifts, but making sure they don't crack over that 10-hour mark where they'd require a break and when they'd also be paid double time.
Right.
So I just thought it was interesting sort of insight into the jobs market, company costs, how it all sort of comes together.
I reckon Michelle Bullock's taking some notes as we speak, Anthony. That's the sort of gentle softening in the labour market she wants to see.
Absolutely.
Now, I'm going back to the kitchen again, Anthony. I can't quite believe this, but I spoke to both our big insurers. So that's Suncorp, that owns AAMI and other brands, and then IAG, which owns brands including NRMA. They both reported this week, and no surprise to anyone out there who's opened their bills recently, they reported they'd whacked consumers with big premium increases, about 13% for motor insurance and about 16% for home insurance. Now, good news, Anthony, your motor insurance is coming down next year.
Is it?
You don't sound too sure. The inflation's starting to moderate in car repairs and parts, so that's good news. But I'm not so sure your home premiums will be slow to drop, and the reason might be the fancy fridge in your place. Now, insurers are having big trouble with what they call escape of liquids, which to us is more commonly known as water leaks.
Yeah, right.
Flexible pipes are breaking more often, and we also have more plumbing in our house. We have extra bathrooms, the powder room, But we also have those fancy fridges that are plumbed and, they dispense chilled water and ice. So compounding it all, we also live in more open plan homes. Once upon a time, a leak would have been contained to the kitchen or the laundry, but because we have open plan homes, a leak might get out and go through all the living areas, causing much more damage and costs, and the insurers want to recoup that cost with higher premiums. So, Anthony, look very suspiciously at your fancy fridge this week. It might be the problem causing inflation to keep rising.
James, I've always wanted one of those fridge with the ice cube machines.
Don't do it.
I just worried you spoiled it for me.
I might have.
We have lots of listeners that are probably listening to this in their cars. Cleanaway's Mark Schubert's one of them, driving home on Friday night. And the Ampol result really caught my eye. Now, Ampol sells fuel. You see them, petrol station, it sells 7.5 billion litres of fuel just in the past 6 months. So that's a lot of fuel. But just in terms of petrol stations for customers like you and me, James, it sold 1.8 billion litres of fuel.
Okay.
Now, the first thing that surprised me, James, was it sells considerably more diesel than petrol. But I guess that shows you, what's on the road and the way that the vehicle trends are heading.
Cleanaway trucks.
Exactly. But the second thing was that it sells more premium fuel, the expensive stuff, whether that's premium unleaded or premium diesel, than it does non-premium fuel. So 54.8% of its fuel sales were premium fuel in a cost of living crisis.
Yikes.
Now, what surprised me even more, James, was that, I fill up with E10. I thought that's the base level stuff. I thought everyone filled up with E10. It's the one that's advertised on the boards out the front.
Yeah.
It seems to be the one that's most accessible, easy to pick up. I've never questioned my fuel choices. I just thought that's what everyone did. But it turns out apparently not. E10 sales accounted for only 5% of fuel sales by volume, James. 5% in a cost of living crisis.
Right.
Now, Ampol sells 4 times as much regular unleaded and 3 times as much premium unleaded as it does on that E10. So that was news to me, James. And I know it's sort of been trending in this direction for a while. You got to go down to slide 32 in Ampol's chart pack to see these details. And maybe I just haven't scrolled down that far in the past, but that push towards premium fuel is actually growing stronger each year in a cost of living crisis.
That's fascinating. I wonder if the RBA needs to start an E10 index. This might be the way to see how tough consumers are really doing it. That said, I have been sort of scanning a few car sites recently, and there are some cars that can't take E10 or isn't recommended to have E10. So I'm with you, Anthony. I didn't even really know there were other fuels other than E10. So I will pay more attention at the Bowser next time. It's fascinating.
I thought premium unleaded was for Ferraris. Turns out not.
Fair enough. Well, I don't have either of those problems at the moment. Let's finish off with, for those of you who have subscribed to our Chanticleer newsletter, which you can do at join.afr.com/Chanticleer. We've been putting out a results wrap most days over the last couple of weeks, bringing together all the best results from the day. And we've included the most interesting graph that we find in a company presentation on that day. On Thursday, we chose one from childcare company G8 Education, which basically argued that it's got strong demand driver. Female participation in the workforce has marched steadily higher over the past 7 years. It's up from below 60% in 2017 to a touch under 63% today. It's clearly a way to go here, Anthony, but what this says to me is a couple of things. Female participation is improving slowly, but I wonder if it also says childcare will again be a battleground in this federal election next year. And I reckon flexible work might also be key to building on some of those gains in female participation. So again, Michelle Bullock, all about holding on to the gains in the employment sector. Let's hope that those gains are evenly shared and we keep this female participation number ticking steadily higher.
It's a good question, James. Childcare is one of those things. It's a hot issue while you're in it, while you're involved in it. And I know, we're sort of in it at the moment, so you switch back onto it. But it's funny. It seems to be one that people go through it for 5 years or 10 years or whatever, and then it quickly gets left behind. So it hasn't really been any great changes.
Yeah, but it's an area that makes all the difference. The research shows. So I think it'll be another important election issue for next year.
Well, James, let's move to our second topic, and it's one I'm really excited about. Next week, Macquarie is due to receive final bids for what promises to be the deal of the year, the takeover of Australia's pioneering data centres business, AirTrunk. Now, James, this deal will be truly massive, with bids likely to come in around the $20 billion mark. But this is also a deal that pulls together many of the big topics of the year that we talk about all the time: artificial intelligence, energy, private capital, and it will likely cement Australia's newest billionaire. But James, let's set the scene a little bit. What actually is AirTrunk, and who's behind this business?
Yeah, well, AirTrunk is, I guess, Australia's leading data centre business. It does what are called hyperscale data centres, which sounds super cool. Just really means they're bigger than your average data centre or bigger than the data centres of yesteryear. AirTrunk's got 11 data centres around the world, some in Australia, up in Asia, including in Japan. But I think the best part of this story, Anthony, is the guy behind it, Robin Kuda.
Yeah.
He's about 45 years old. He came to Australia when he was 18 from Bangladesh. And he worked in telco for a while. 2014, he decides to strike out on his own and get into the data center game. Now, spends a couple of years sort of trying to land a data center and some customers. Gets down to the wire in about 2016. I think he's got a contract to provide a data center, but he needs $400 million to fund that data center. And things got very, very tight. He spoke at an event that the Fin put on earlier this year, and he basically said he was near bankrupt. And actually, this is a bit naughty, he dipped into his super briefly because he was self-funding this business. But lo and behold, he pulls it off. He raises the $400 million. He builds that first data center, and he just keeps going. Now, Anthony, we've seen Robin speak. He just seems like a lovely, unassuming, humble, quite a funny guy. And now he sort of stands at the precipice of this awfully big deal. Anthony, you mentioned that this deal brings together AI and energy. As I said, AirTrunk's been going since 2014, back when ChatGPT was just a twinkle in Sam Altman's eye. But has the AI revolution changed this business in the last couple of years?
It's definitely changed the trajectory of the business. I mean, Kudo was a visionary in Australia, but I mean, even he would probably admit he got a bit lucky. And I know his co-investors at the moment, Macquarie and PSB, which is a big Canadian pension fund, I mean, they would admit that they got a bit lucky. I mean, like you said, Kuda came from the data center sector. He was working for NextDC, which also builds data centers and leases them. But they build the smaller ones where you lease the space to the underlying customer, basically anyone that uses data, our employer, for example. But, Kuda changed the game. He said, no, that's not the future. The future is building these much larger centers, these big powered shells. And you can lease the whole thing to the big tech companies. You can lease it to Microsoft, Amazon, Google. I mean, particularly Microsoft. Microsoft's a big part of the AirTrunk story, and he's spot on. You build the big data center, you lease it to one of these big tech companies, and then they look after all the customers and everything for you. So it really sort of changed the game in Australia. I mean, back when he got into it, I mean, and in the years since, demand for data centers has been strong. People are using more data. Just think your iPhone, maybe your Tesla, maybe your work email. Is there a data limit on it anymore? Probably not. We always used to get asked to clear out our inbox. Now that doesn't happen anymore. Then chat. So it was heading that way. And then ChatGPT comes along and it's just like kaboom, all of a sudden the big tech companies need data centers for these large language models, which are the ChatGPT or whatever. And their clients also need more space for the way that they're using the large language models and the way that they're trying to get more out of their data. So it's put a rocket under AirTrunk's expansion plans. Like all of a sudden, all the data center operators are saying that the clients are bidding for more space. There's a bit of a land grab going on. It's much easier now to get customers than it is to actually get the land, the people, and everyone to build the data center. So ChatGPT's really just ramped up that demand and is a big reason why AirTrunk's likely to sell for such a big price.
But hang on, Anthony. We've spent most of this year talking about how hot data centers are, how hot AI is. Macquarie have got their hands around a gold mine here, haven't they?
Yeah.
Why on earth would Macquarie and PSP, this Canadian fund, want to sell AirTrunk right now?
Yeah, Macquarie, I think, owns about 55% of it, and PSP's got about 30% of it, and Kuda's got the rest. Macquarie and PSP only invested 4 years ago, back when AirTrunk was worth $3 billion, had probably 6 data centers. Its big one in Tokyo was just in the works. Now it's got 11, like you said. But the reason why it's time for them to think about it is this thing's growing like a weed still, and it's a really capital hungry business. It requires a lot of equity funding and debt funding to grow, to build these new data centers. So I think a data center, a big hyperscale data center, James, and Greg Goodman told me this last week, actually runs Goodman Group. He said, and this was his words, they're $1 billion a throw.
Yeah.
Right? So they're expensive. They're big and they're expensive to build. Now, every time you build one of them, you've got to say put in $500 million of debt and $500 million of equity, something like that. So you need to keep injecting money into the business. And it's probably not at the stage yet where you're pulling out you can fund itself, such aggressive growth. So, I mean, Macquarie and PSP, they've done incredibly well. They will have made billions, but they don't want to keep writing equity checks into it. I mean, Macquarie's fund, it's a closed-end fund, a 10-year fund, so it invested and has to give that money back to investors by a defined date. So you're right, James. I mean, this is one of the hottest investment thematics in the world, and perhaps they could just sit on it, keep writing up the valuation, keep their investors happy. But, these guys are bigger deal junkies than me, and they know that when there are buyers out there and when it's hot, that's when you want to be a seller, not a buyer. And James, out of everyone I've spoken to on AirTrunk this year, you're probably the only person that's asked me. So why are they selling it? And it's such a good question. I mean, are you surprised that they're not sticking around?
Oh, I am a bit surprised. Yeah, I mean, we've seen. I appreciate what you're saying, that it's in a closed-end fund, but we've seen ways around that, continuation funds and other sorts of vehicles. So, but I can see what you're saying too. You sell when the value is highest, and you strike when the iron is hot. So, Anthony, who's going to buy this thing? Is this a company that's going to do a Guzmani Gomez and end up on the ASX at some stage, or is there some deep-pocketed super fund or big investor from overseas going to snap this up?
It may end up on the ASX at some stage, but right now is not the time because it's too hot. There's just too much private capital money around for it. That the big groups, the Blackstones and the KKRs of the world, the big Canadian pension plans, Australia's own IFM investors, they're too willing to get in there behind it, fund its growth, and maybe when it becomes a more mature, stabler, self-funded sort of business, then the multiple won't be as high, it won't be worth quite as much. Maybe then it will go to public markets. But the way that it's growing and the valuation it's at, the longer you wait, the harder it's going to be to get it to public markets, right? It could just get too big.
Yeah, okay. It's only August, or the end of August, Anthony, but is this the deal of the year? Is it too early to call?
Well, the other contenders have fallen over, James. So
Yes.
At the moment, this very much looks like deal of the year. You'll remember that BHP went after Anglo American and didn't happen. You remember that Woodside was in talks to buy Santos?
Didn't happen.
So in the absence of those two, and just given the story, particularly, as you said at the top, the story around Robin Kuda, just how well he's done, the timing of it, it's AI, it's energy, it's private markets, just brings together so many of the strong thematics. I reckon this is very likely to be the deal of the year.
Yeah, it's either this or the Burrito Brothers at Guzmani Gomez, I reckon. So who would have thought that burritos and AI would be mentioned in the same sentence? But there you go. All right, Anthony, we'll come back after the break. We've got a great question from a special correspondent on inflation. Back in a sec.
I didn't realise I could stick with my industry super fund when I retired. Thankfully, I discovered if I stayed, I could set up a regular income, take money out when I wanted, and the rest can grow over time.
Stick with your industry super fund in retirement. Visit compareyourretirement.com today.
Past performance is not a reliable indicator of future performance. Consider the fund's PDS and whether the product is right for you.
Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday, the newsletter pulls together the best Chanticleer columns from the week and the best bits of this podcast and delivers them straight to your inbox. All right, Anthony, quick look at the week ahead. Kamala Harris accepted the Democratic nomination on Friday. So the race is basically officially on. We've got our fighters, Trump versus Harris. This race is getting really close, Anthony. You wrote this week that it's all about Pennsylvania. Why is that?
Yeah, James, I interviewed Libby Cantrell from US fund manager PIMCO, one of the biggest investors in the world. Her job is to watch US politics and everything, so she should know what she's talking about. She said there's basically six states this is going to come down to. Pennsylvania is the number one seat that Kamala Harris has to win if she's going to get to the White House. So she reckons if you want to feel for what's going on in the election, just watch the polls in Pennsylvania. But Libby also warned that this is peak summer in the US. In her words, everyone's at the beach. We need to wait until Labor Day in the US, which I think which is in the first week of September. Wait till then when everyone's back a little bit more tuned in and the polls should become a little bit more accurate.
All right. Another big speech in America will be on overnight, Friday night, from the Federal Reserve Chairman Jerome Powell. He'll speak about interest rates. Markets are still saying that interest rates in the US will come down by 1% between now and the end of the year, which suggests some very big cuts are coming. I don't know whether Powell will push back on that a little bit, but let's see. And then results season wraps up next week, but with some really big names, including BHP, Woolworths, Coles, Qantas, Wesfarmers. Anyone you're really looking forward to, Anthony?
Oh, all of those. Love the blue chips. I mean, this week's been good. It's been a frantic week of results, but next week we've got the real headliners, don't we? Yeah,
the supermarkets will be really interesting. All right. We love questions here on the podcast, and this week our question is from Eddie from Narrabeen Sports High School. And if you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. As Eddie's done, just record a voice memo on your phone and include your name and where you're from and email it to us. So here's Eddie.
Hi, Chooks. My name is Eddie, and I'm a Year 12 student at Narrabeen Sports High School studying economics as one of my core subjects. Current monthly CPI data according to the RBA is 3.8%. If food, petrol, insurance, energy, and other bills have displayed price increases of around 10 to 30%, how do we achieve an average inflation target of around 2 to 3%? Do you think the government can align their fiscal goals with monetary policy?
There's a bit in this, Anthony, a few sort of things to think about. Eddie has nailed one of the sort of great conundrums of inflation, that while the RBA is focused on the rate of inflation, so, you know, that's that 2 to 3% increase that it wants to keep inflation at, us poor punters out there have to deal with the fact that we're paying 10 to 30% more for some of those staples, food, petrol, over a longer period of time. And so Eddie's right. There is that, while the RBA is focused on the rate of change, there is that psychological effect of those big price movements that we've seen over a longer period, say 3 or 4 years. So yes, that is something that the RBA will be thinking about, because what they want to avoid is people's inflation expectations starting to change, where people always expect that prices are going to start rising by 4 or 5% because that's what they're getting used to. So that's the challenge for Michelle Bullock. That's what she's been very careful to, that's what the RBA's been very careful to avoid. And we're not there, thankfully, and we are seeing inflation start to moderate. Back on petrol, Anthony, I don't know if you've noticed, but we've really seen some big moves down in petrol in the last little while. $2.20 a litre back to about $1.70 a litre in some places. So that's a bit of good news for Michelle Bullock. Eddie does ask a good question, though. Do you think the government can align their fiscal goals with monetary policy? Huge government spending going on at the moment. Michelle Bullock doesn't like to come out and sort of lash the government for this, but it doesn't make the RBA's job any easier, does it?
Definitely. I mean, that's a huge risk, Eddie. I mean, Eddie is at Narrabeen Sports High, but he's clearly not a buff-headed footy player or javelin thrower or whatever. He's got his head screwed on. There's an election coming up, all right? And it's always so tempting for the politicians in elections to splash the cash around and buy votes. So watch them tie themselves in knots in the coming months, Eddie, as they try to argue that their spending is not inflationary. It's going to be one of the issues. I mean, he's bang on with the first bit of the question. We just can't get inflation down to 2 to 3% while the price of bills going up. You just can't. And that's exactly why the RBA board has not cut rates yet. It's exactly why they even talked about potentially raising rates at the last meeting. I mean, demand is still outstripping supply in the economy. So until it doesn't, and until we start have a bit of time going backwards, it's going to be that way.
Yeah. Well, Anthony, after a big week, I want you to make sure you get out there and buy the cheap petrol on the weekend and enjoy a bit of R&R.
Thanks, James. Have a good weekend.
Thanks, everyone. We'll see you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, their daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson and Anthony McDonald. And it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.